Well, hello, ladies and gentlemen. Happy Tuesday, January 7th, 2020 to you all. My name is Mike Chupka. I'm the Director of Education here at Power Options and at RadioActive Trading. And today we're going to discuss why use a radioactive trade, or what is the point of a married put in your portfolio. Now, in this brief presentation, I want to share with you the whys behind we personally here trade and advocate the radioactive trading techniques. We're going to discuss what is a radioactive trade. Based on the detractions, why would anyone use this in their portfolio? There's so many other strategies out there that sound sexier and generate income right away and look like they're going to be more profitable. Is it really better than other strategies that we as options traders have at our fingertips? And who really benefits from this technique going forward? Now let's start at the very beginning. What is a radioactive trade? Well, it's a protected stock structure. It's a married put technique, the initial setup that is, which is nothing new, but it's done in a different way to take advantage of the three core principles which really apply to any option strategy. Once the position is entered, we then adjust the positions, still generate income, lower the risk, adjust the cost basis, manipulating our second asset, which is the put option, in what we call income methods. This is the most conservative way to trade options in your portfolio. Now, the initial structure. Let's take one that came up from the married put search today on Winnebago, currently trading at around $51.34 per share. We'll take a look at what we call the 5-line setup when entering a new radioactive trade. So I'd buy shares of Winnebago, sorry about that, PLNT, it's not PLNT, it's WGO, at $51.34. Today, January 7th, I'd then buy a July 55 strike put, about $4.60 above the current stock price for $8.20. My total investment would be $59.54. But what does that 55 put give us? It gives us the right at any time between now and July expiration to force someone to buy our shares of stock at $55. So even if Winnebago falls due to poor earnings or a surprise negative earnings, or the market itself declines drastically, the worst case scenario we could experience is losing $4.54, or 7.6% of our total investment in the position. That's simple enough, right? But breaking that down, what are the common detractions and questions? Well, the stock trading at $51.34, we've increased our investment to $59.54. Why would I add 15% to the underlying cost basis? Buying a July 55 put, why am I buying a put that's so far out in time? Why am I buying a put that's in the money, above the current stock price, instead of a cheaper put that's maybe at 35, 40, or 45 strike price? Is it really a guaranteed exit? Absolutely. We've bought a contract that gives us the right to force someone to buy our shares at 55. Winnebago could collapse 35, 40% tomorrow, where your stop order would be violated and you'd get out at a worse price than you had originally hoped. But this case, you're guaranteed to get $55 back. So each one of those, why add 15% to the cost? Well, with insurance, for your car, for your home, you get what you pay for. And the same thing is true with investing. The July 55 puts at $8.20. That's about 15% of the underlying security, but it controls my risk to single digits. Now we see here that April 55 strike put, only 100 days out in time as opposed to 192 days out for our selected put option here, is priced at $6.60. So we're almost getting twice the amount of time by going to July, but we're not paying $13.20. We're not paying $12. We're not paying double the cost. I could buy a January. That's this January, 10 days away, 55 put for only $4.10. That is half the cost of the July put we're looking at, but it's only 10 days. I'm 20 times the amount of time of insurance policy at only half the cost, not 20 times the cost. So just as with insurance, you get a discount when you buy 6 months or even a year out in time. The option that's twice as far out or 6 times the distance out is not twice or 6 times the cost. We get a benefit of buying further out in time to pay a lower cost per day on the insurance policy. But why July? Well, we just saw some of those benefits, but the second benefit is because of the time decay curve. Let's say that we entered that Winnebago position, and we have our July 55 put, and in the first 33 days, Winnebago goes up to $55 per share. What would happen to that January 55 put that only had 10 days to expiration with the stock trading at 55? It would go to zero. We'd lose the full 410 on that put option. But because we purchased the July option that's further out in time, even in the first 10, 20, or 30 days, the stock can go up. Our put won't go to zero. In fact, we might only lose 80 cents, $1 of time premium, as opposed to 410, which is intrinsic, but also some time premium as well. We'll still have a strong value on that put option. And if the stock stays the same in the first 20 days at 51.34, we're likely only to see a loss of 50, 60 cents or so on the put option, still retaining most of that 820 that we bought, because the time decay won't start to drastically fall until the last 30 to 45 days as we get closer to July expiration. Now, we looked at an in-the-money put out to July. We've already seen a couple reasons why the July put would be better than the shorter term as you might be used to with a standard married put. But in a radioactive trade, we look specifically for strikes that are maybe 1 or 2 strikes in the money and give us that good risk of about between 3 and 8% on the position. I could pay less than half the cost and buy that July 45 put, still give myself 192 days of protection and only pay $350. But here I'm at a loss of 18%. The insurance doesn't kick in until you hit the out-of-the-money strikes, so you lose a lot of intrinsic, and you may be losing some time value as well. Now, this is important because it falls into the gambler's ruin. Now, sure, I could buy a cheap July 40 for only $205, which takes a 25% risk. But if the unexpected happens, poor negative earnings, deep decline across the market, if I do take near that full loss of 25% on my investment in this position, which would be about 53.36, I'm going to need a 33% gain on what I have left to get back to break even. If we went really cheap and went for that July 35 and Winnebago collapsed and drops down to $36, $35, $34 per share, and we take near that 33% loss on a position, I now need a 50% gain on what I have left to get back to break even. That's the slippery slope of gambler's ruin. But if I take a 7% loss, or even a 5% loss, I'm not going to need a 10, 12, or 15% gain to get back to break even. It's only going to be around an 8% gain, or in this case, a 5% gain to get back to break even. That's the proper structure, is controlling risk to this level, not falling into that slippery slope of gambler's ruin where we need much larger gains to get back to break even when those occur. Now, what do we talk about when we say a guaranteed exit? Many of you have probably traded stock. You've probably traded covered calls. When you opened a position, you might have followed some of the rules, such as at Investors Business Daily, IBD, and you set a stop around 7, 8%, maybe 10% of the underlying stock position. When we purchase a put option, we're guaranteed to get the minimum strike price back. But that is the absolute worst case scenario in this structure. When I open a position, my put doesn't go to zero automatically. It's not a wasted asset at all. All I'm risking is the bid-ask spread. If I enter this Winnebago RadioActive Trade today, bought the stock at 51.34 and purchased that 55 strike July put for 8.20, I could turn around and liquidate the position right away. Sell the stock for 51.34 and sell that July 55 put for maybe $8, maybe $8.10. All we're risking when we open the position is the bid-ask spread. Is my break even 59.54, my cost basis? Well, the answer to that question is yes, if and only if I hold the position all the way to July expiration. I make no adjustments. I generate no income, except no dividends if Winnebago pays a dividend. And if the stock is below 55 at that time, all the time value has gone out of my put. The worst we could do is lose 7.6% on this position. Because of the proper structure, if Winnebago goes up $1 tomorrow to 52.34, well, I'm not at a $7 loss because my cost basis is 59.54. We're actually going to be at a profit, about 40, 50, or 60 cents on this position if Winnebago moves up 1 point, because the put's not going to lose as much as the stock. And we still have all that time, and we're not going to experience a lot of that time decay until we get closer to July expiration. Now, as you can see here on the profit and loss chart, that curved red line is showing us sort of what the break even is at the halfway point on around April 14th. So even if the stock just moves up to $54.50 or $55, I'd be at break even because there's still a large amount of time value remaining on my put option. I don't need the stock to go up to 59.54 to see a profit. I only need the stock to be at 59.54 to see a profit if we hold it all the way to July, make no adjustments, accept no dividends, then yes. But that's not the goal, and that's not how we approach the trade. We're not just going to leave the married put open and do nothing for 8, 9, 12 months. So in summary, the initial radioactive trading structure is a limited risk strategy that protects our investments to single-digit risks, helps us avoid gambler's ruin and the lie of leverage. The selected put may seem different, and it may seem expensive, but it maximizes the insurance. We're paying a lower cost per day by going further out in time. We don't face the fast rate of time decay as with a standard married put that's a cheaper price, doesn't give you a good deductible because it doesn't kick in until the stock falls to that price. It puts time on our side. We're not forced to be watching the market, watching every little trend, every 5-day or 6-day MACD or simple moving average or EMA. We have a controlled risk in place. We can step back, and as the market moves up and down, we can make adjustments, or we can do nothing and just wait till we see a better opportunity in our position. And remember, the put is not just insurance. It is going to change in value and price as the stock moves up and down. It's actually a second working asset that can be adjusted to lower the risk on the position as well, to adjust the cost basis and lower the cost basis on the position, or to potentially profit in 2 directions. But you look at that structure, and one of the main detractions is we see the profit and loss chart, and you look at it and you say, but isn't this just a complicated long call? Why not just buy the call? Well, when you look at trading, the radioactive setup, that married put structure we just showed, is not a parity trade to just buying the long call. There's another caveat to make them a parity trade. You'd have to put the full cash aside that you would use to buy shares of stock and buy the call to make it a parity to the radioactive trade. The profit and loss chart is similar. We're not arguing that, and we never would, if almost not the same. But remember what we just talked about, with the lie of leverage. Buying a call option for reduced capital, trying to use margin, and trying to use leverage, you risk 100% of what you invest in the trade. And this is where investors, even those who are disciplined, get into trouble. By overtrading, risking 100% of what they have, experiencing a bad market condition, and before they know it, they're at 50, 60, 70% loss on what they put into the long calls. So our long call parity, which is not a parity, same day today, instead of buying shares of stock at 51.34, buying that July 55 put, I could just buy a July 55 call. It has a bid of 440 and an ask of 470. The midpoint would be 455. The structure looks the same. The profit and loss chart looks very similar. But remember, I am risking 100% of that 455. The monetary risk is about the same. But let's think about it another way. If I had $6,000 of free capital right now to invest, I could enter into the married put for Winnebago and have a cost basis of $59.54, $5,954 for 100 shares of a married put position. You have $6,000 to invest in a new position. You say, okay, well, Mike posted this in the Fusion account. Mike's talking about this married put. Let me go ahead and buy that July 55 call. But I've got $6,000. I'm not just going to buy one call at 455. Let me take a fifth of that. Let me put in about $1,200, $1,300, and I'll buy 3 contracts, let's say, at 455. That puts you at about, $1,200, $1,300. Now, what do you do with the remaining 4,700, excuse me, that you have in your portfolio? Well, now you might buy 5 call contracts on stock XYZ, another 3 contracts on stock ABC, and so forth. So now you allocate a little bit more of that $6,000 to 4 or 5 positions. The market turns. A subtle correction happens. Most of the stocks that you're in drop 5, 6, 7% in the first 20 days. What are you looking at? Well, you're looking at close to a 40 to 50% loss on all of those positions. More than likely, close to a 40 to 50% loss on the $6,000 that you nearly allocated to these different 5 positions. Winnebago could drop 7 to 10%. I'm only risking 7% of that $6,000 I invested into the position. Well, you can set stops on your long calls. That's true too. But can you set a 7, 8, 5% stop on a long call? Not likely. You're going to get wiped out right away. In a lot of cases, you'll get wiped out right away because they'll look at the bid price to sell to close the call at your 5 or 6% stop. And it's possible that even if you got the midpoint price to enter the position, the difference between the midpoint and the bid would be 4, 5, or 6%. Most long call investors will set a stop at around 40, 45, or 50%. But if you have 5 or 6 positions, bad market conditions, little pullback, some events going on in the world, a little bit of tension right now, a little bit more volatility, you could be stopped out of those positions quickly. And even if you do set a stop at 40% and all 5 of those long calls you opened or closed, where's that $6,000 that you had allocated? It's down 40 to 50%. And what did we see? You take a 50% loss on your investment, you're going to need 100% gain to get back to break even. That's kind of risky, isn't it? So if the graph is the same, why aren't the trades the same? Because in reality, the lie of leverage, you have to remember, works both ways. Now we can say if Winnebago goes up 10% in the next 30 days, gains 513 and goes up to 56.47, you'd have about a 53-55% gain on the long call. And you'd be right. Using a Black-Scholes calculator on power options, and you can test this in a Black-Scholes calculator to your broker, theoretically the call would go up to about $6.98, about $7. Well, you paid $4.55, so you've got a gain of about $2.45 on the position, which is your 53% gain. Now, the married put, of course, would have a gain of roughly 5%, because as the stock moves up, the put's not losing 1-to-1. It's only going to lose about $2, $2.20. So our total position would be up $3, or roughly 5% of that $59.54 I invested into the trade. But if Winnebago falls 10% to February 7th in the first 30 days, drops 5.13 down to 46.21 per share, long call is going to have a drop of close to 2.25, a loss of 2.31 or 51% of what you invested into that long call. The radioactive married put would be at a loss of 2.22, but that's only 3.7% of the investment. The monetary levels are about the same, but it's the percentages that hurt us. Because remember, if the stock does fall, of course, that 5.13, we're going to see a gain of about $2.90, almost $3 on the put option to counter that. That's the benefit of an insurance policy, but we're still only in single-digit risks and just about half of the maximum risk on the position. And why does this matter? Well, we're going to take a look at the Trade Simulator tool. This is a free resource you can get. Just go to RadioActiveTrading.com, click the Resources tab, and you can enter in your numbers. And what numbers am I talking about? Well, a Trade Simulator tool takes your projected win percentage. How much do you make on average on your winning trades? We can set in what is our loss rate. What do we expect for our average losses on the strategy that we're using? We can plug in an investment amount and an allocation. And what the tool is going to do for us is flip a coin 100 times. Heads, we make the expected or average win percentage on our strategy. Tails, we take the loss of the expected loss percentage. Let's take $10,000. Allocate 25% to each trade. And we're going to make 53% when we're right, that 10% increase in Winnebago for the long call, and we're going to lose 51% when we're wrong. Now, with all technicals, all fundamentals, all the research you can get, if we just assume a basic probability of 50-50 win-loss ratio, our buy and hold strategy, half the time the stock goes up, half the time the stocks go down, just like the long calls, half the times the stock goes up, half the time the stock goes down. We take our $10,000, we allocate a fourth of it to each trade. With a 50-50 win-loss ratio, at one point during the simulation, you see the strings of wins and losses here, and it did that iteration 100 times. You can scroll through it and see it. But at one point, the portfolio moved up over 100 or close to 150%. We would have seen a high value of 24,000 from our starting point of 10,000. But at another point, the portfolio had a drawdown of about 62%, dropped down to only 3,800 from our starting point. How long would you continue a strategy in your account that after a few months of trades, or maybe after 30 or 40 trades into the strategy, you see a 63% loss on what you allocated to it? Highly unlikely we would continue. And over time, even though at one point we saw this large possibility of about 150% gain, it doesn't pan out. We're down about 45-50%. Why? Because of the lie of leverage. If I take a 51% loss on a trade, I don't need a 53% gain to get back to break even. I need closer to a 103, 104% gain on what I have left. Is that possible with a long call? Yes. But in trading long calls in your portfolio, how often have you seen 100 or 200% gains? I doubt it's 50% of the time. It's probably closer to maybe 20% of the time. The average, the wins and losers, is not making up for the average we took on the losses. That's the lie of leverage in action. Even though you can see 53, 100% wins, sometimes you might only take a 20% because the stock didn't move as you expected. But over time, even with a 50-50 win-loss ratio, this does not get you to profit. It gets you to a 40-50% loss. Now, if we had more winners than losers, we might see a profitable portfolio. And one time again, we might see that 120, 130% gain on our investment. but we also see what? At one point, a little bit more than a 50% drawdown in the portfolio, but we do end up with a profitable record of about 20% gain from our original starting point of $10,000. Not what you were promised with long calls, is it? And you were promised the opportunity of maybe making 300% in 4 days, or 2-week trades that earn 400%. And again, that's possible, but consider the average over time. You're likely not going to be seeing that on every trade. And remember, you can't set a stop at 10-15% because in that case, you're closing out more positions when they hit that trigger, and you're nowhere near a win-loss ratio of 55 wins, 60 wins, or less. Now, of course, you can do extremely well if you're right. If you had 60% winners, 40% probability of loss, and you can plug that in yourself and check it, you might see a portfolio, very high leverage return of $85,000 from $10,000. But at that same time, even with a 60% win ratio, you might have seen a drawdown, 40-50% on the total portfolio. But if you have an unfortunate string of losses, even targeting a 60% win ratio, a 40% probability of loss, because the lie of leverage works both ways, you can still end up with a severe negative decline because of what the market offers, and you can be bankrupt after a fair portion of the trades just because that lie of leverage. And in this case, we see the high point was reached in the very first trade. That first 51% win on 25% of what we allocated. It never went above that during this 81 trade iteration with strings as winners and losers. We could have had another 20, 19 winners here. Got us close to that 58 win ratio to 52 losses or so. And we're still bankrupt before we reached 100 trades. Don't have enough to keep investing on the position. How long would you continue? But what's the point? Well, let's compare. Instead of making 53% on winners, losing 51% on our losers, keeping the same 50-50 win-loss ratio, if I only make 5% when I'm right on the winners, and control the loss a guaranteed, not like a stop order, but a guarantee, and I only lost 3.7% on my losers, the win-loss is the same at 50%, same allocation, I could actually be wrong more often than right and still make a profit. The drawdown, no more than maybe 2, 3, 4% on the total portfolio because of the proper structure. Even being right, less than I'm wrong. It can still put us to a controlled risk, obviously, but still put us to a profitable portfolio and a profitable gain. Your targets might be higher than that, and that's fine. Of course, if we were right more often than wrong and had a 60% win ratio, we'd have a much higher target of success and still probably only see a 5 or 6% maximum drawdown on the total portfolio. Now, other leverage strategies have their place in a portfolio, but it should not represent the larger portion of your portfolio. Over the past almost 19, 18 years I've been here at Power Options, I've heard all the stories of investors making $20,000 on bull put credit spreads in 1 month, and then $30,000 in credit spreads the next month, allocating about $100,000 to credit spreads. And then in the third month, they lost about $60,000 because of the lie of leverage. It's not to say you can't be successful with some of these strategies, but it should only be a smaller portion of your portfolio. The larger portion of your portfolio should be in the proper structure that protects investments, locks in your gains. And the only strategy I've seen in 20 years of trading options where you can actually be wrong more often than right and still have a profit. That's not the goal, but keep in mind, we just saw how a 60% win ratio in a leveraged trade could result in a very high gain, never denying that. But personally, are you right 60% of the time? Meaning that when you're right 60% of the time, you're making 53% on those winners on average? Probably not. Remember what we also saw, drawdowns of 60%, 62%, or even bankrupt, dropping down about 98% of the total portfolio value in a scenario with this type of leverage strategy that sounds really attractive and has this high promise. But would you even take it that far? Would you allow that loss to become that big, or would you stop trading once you hit a 30% decline in your total portfolio, 40% decline, or even 50% decline? And then you might say, well, there's still this promise for this leverage strategy to be successful. I just need to adjust my stops and need better management. Well, if I was entering a bunch of long calls and I set a stop at 30% or 25% rather than 40 or 50%, I'm closing out half of those positions that may have even gotten to a profit sooner, because at one point or another, they're probably going to hit that 25% loss. Now it's almost impossible with too tight of a stop on these types of leverage strategies to get that 60-65% win ratio. But is it really better than all these other strategies we have as options investors available to us? Now, what do you think are the most popular strategies? Another way to phrase it, let's talk about this. What strategies are you trading right now? Are you trading mainly covered calls and naked puts, sort of cousins to each other, we could say? Similar risk reward, similar goals. Are you trading mostly credit spreads, bull puts, bear calls, maybe some debit spreads mixed in there as well? Are you mostly buying calls and buying put positions? Maybe doing some straddles in there as well? Are you looking at the diagonal calendar spreads, buying a far out in time call, maybe slightly in the money, and then selling near-term calls against it? Or maybe just even buying a 2 or 3 month out call and then selling weekly calls against it as well. Or perhaps you're doing something other. And of course, if you select that you're doing other as the main portion of your portfolio, why don't you go ahead and just let me know in the comments section as well. So I'm going to leave this poll open for a little bit. I encourage you to vote. I'm going to take a look at all of these. And if anyone comments with the other strategy they're mainly using, we'll take a look at that as well. All right, let me go ahead and close the poll, and I'll share the results with everyone. Let's see here. So, that just exited the poll. It closed it out. It's not going to let me. I'm sorry, folks, it's not going to let me share it, but let me read this out real quick. A large portion of today's attendees, about 60% or so, are doing credit spreads and debit spreads, meaning it is the main portion of their portfolio. We've got 22%, looks like, 22%, I'm sorry, trading covered calls and naked puts. I've got 8% doing long calls, right? So that's about 90% or so of our total. And then the remaining looks like 8% or so. It didn't get quite to 100. 8% or so said they're trading other, but no one commented on what the other strategies were. No one's trading the calendar spreads right now. Okay, well, that's perfectly fine. Here's what I'm going to do now. I showed you some screenshots of what I did this morning on the Resources tab, taking a look at our long calls versus the married put position. Now, I'm going to navigate over to RadioActiveTrading.com. There we go. And here's just the basic look of RadioActiveTrading.com. Let's check our audience view. Fantastic. I'm going to click the Resources tab up here at the top, and I'm going to scroll down here to that Trade Simulator tool. Okay, we're going to kind of keep our allocation the same, but just to show you that I wasn't fudging numbers, let's put in that long call again. 53% average on the winners, if we saw a 10% gain in the stock. 51% average on the losers, if we saw a 10% decline. And we assumed a 50-50 win-loss ratio. We're going to change our allocation to 25% of that $10,000. So here's that profitable track record again, 53-54% wins. We get about a 50% gain on the portfolio, not bad, but we had to suffer a 57% drawdown in the portfolio at one point in order to see that. There's a 55-55. I'm going to try to get to 50-50. There's a terrible track record. We'd assume that would happen. Almost bankrupt again. And each time I click it, it's just giving us a new run. There we go. Okay, so 48-52. I want to get to 50-50, but it's random each time. There's a huge one if we were right 60% of the time. That's what we were talking about, that 85, 100% win ratio. Okay, but see here, we are not going to get right to 50-50. So there we go, 51-49. With that structure, at one point again, we see a chance to win with strings of winners and losers, almost a 67% drawdown, and we're down 30% over time. Let's talk about a covered call structure. The 22% of you that are doing covered calls. If I'm doing a monthly covered call, what do I probably expect? Well, I probably expect to make around 3% return maximum if assigned. That's assuming I'm going right at the money, buying, let's say, Winnebago at 51.34, maybe selling the 1 month out February 50 strike call, or maybe there's a 51 strike available, but probably about a 3% return. I'm going to follow the rules that are talked about on IBD, and we're going to set a 7% stop. Now we're going to change our allocation a little bit. Winnebago is a $50 stock, so if I had $10,000, I'm probably doing closer to 50% allocation into those two positions. We're taking $10,000 and putting in two positions. And let's say that you're even a little bit better. Let's say that you get close to that 60% win ratio. What just happened? Here you have a win ratio of 65% winners. 65% of the time you're right, making 3% on your max return if assigned, and you've set a stop at 7%. Assuming you actually get out at 7%, you don't have an overnight drop where you get filled at a 15, 20, or 25% loss, because the stop order is only assumed insurance. At one point, you start to see a potential profit, but again, over time, it's not successful. You need to be right closer to 70, 75% of the time with this win-loss structure in order to profit. There we go, 69% winners, making 3% return if assigned and you're right on your covered calls, only losing 7% when you're wrong. Not even to a profit. You got to get closer to 70, 75%. Let's try that. Let's put it at a 30% probability of loss, folks, real quick. There you go. 30% return over 100 trades. Being right 77% of the time with just slightly in the money, at the money covered calls, which only have a probability of probably 55% or so, not 77. That's why you're not making the promised returns you were expecting with the covered call or the cash secured naked put position, which might drop this down to 2%, and you might have a better win ratio of maybe 75%. But again, the return might be slightly lower if you're going further out of the money. Now, those of you that do credit spreads, and I'm not against credit spreads. I do it with a portion of my portfolio as well. But again, the smaller portion. The larger portion of my portfolio is in the proper radioactive trading structure. What do we expect with a good probability of, say, 80% on spread trades? Or we could say the short option delta of 20 or 0.20 or less. We might expect to see a 15% leveraged return. But again, just like the long call, I can't set a stop on my credit spread, bear call, bull put, or iron condor of 6 or 7% because I'd be closed out right away. 20 to 25 is too close as well. You see a sudden move like we saw in the last couple days due to the market volatility and outside actions and outside events. I'd be taken out of those bull put spreads right away. More common stop is 50%. So if I open a 5-point spread, I'm going to close that spread if it hits a loss of about 250, half of the difference in the strike prices. But we expect to be right 80% of the time. And we'll change our allocation. We'll start with $10,000, but we'll only allocate $2,500 to each of those leveraged spreads. Oops, sorry. So here's a perfect track record in that scenario. I'm right 81% of the time. You can see about a 50% increase there and no real drawdown because of the proper strings of winners and losers. Here again, 79%, but only a 10% gain. Not what you expect of 40, 30%. Let me change this to 25, get that a little bit better. All right. An 84% would be very well. Now, in my experience, 80 to 85% win ratio is closer to an 11%, 12% profit. Harder to get to 15. In that case, even if I'm right 80% of the time, I'm not making a profit. Naturally, we have to hit that target of 80% to be successful. You see how drastic it can be and how quickly the losses can compile. 75% drawdown. Over time, 68% drawdown if you're not hitting the targets or in your bad market condition opposite your sentiment for the credit spread. Now, a lot of investors tell me, oh, well, why would I even do that? With various credit spreads, I can make a 25% return. But yeah, the 25% returns are closer to only a 70% probability. And in this case, you still see a drawdown, 30, 35% on your portfolio. And yes, you can still have the success rate you want, but if it's below your target, it's at 71% again, you're still not making anywhere near what your expectations were. Why? Because remember, when you do take a 50% loss on a position, what are you going to need? You're going to need 100% gain on what you have left to get back to break even. So that means 4 success rates against 1. You're going to need to be at 75, 77%, not 70% to see success long term. So depending on where you set your probabilities, that's going to dictate. But remember, when you set the probabilities to the proper range, 80, 85%, you're talking more around 11, 12% average gains. And if you miss your target, you're going to be in a lot of trouble. And then, of course, as we talked about before, taking even just a 50-50 win-loss ratio, setting my target to 5% when I'm right, controlling my risk to 3.74% when I'm wrong. I can be wrong more often than right. I can miss the target, still see a profit with just the initial structure of the radioactive trade. And if you have more winners than losers, we're going to be looking really good as well. Try to see if I can get a good win ratio here. A little bit higher. There you go. See? 30% win off the starting investment, being right 55, 56% of the time with no real drawdown going forward. That's the advantage of the proper structure compared to the proper strategies that we're all used to and have been taught to us and promised to us, that 3 to 6% return per month with covered calls. Well, actually, I don't see that often, but if you are seeing that and you are getting it, you might still not be hitting your targets because you have to control those losses. And sometimes with a stop order, you're still going to suffer something unexpected where you have a 20, 25% loss. Credit spreads are a fantastic way, in my opinion, to make money with the proper structure and the proper probability. But again, it can't be a larger portion of your portfolio, because over time, you're going to see 50, 60, maybe even 70% drawdowns. You're not going to have much left to keep trading, and you're going to need more and higher win ratios than what you have left just to get back to break even. And we already talked about seeing the long call versus the married put and how that pans out over time, because the lie of leverage works both ways. And what you just saw is that initial radioactive trading structure alone outperforms the popular and common strategies. But that's a bird's eye view, isn't it? What about management? We can manage all of these positions. But how do you manage a covered call? When the stock moves up, you roll the call up to get higher returns potentially, maybe increase the return by 1 or 2% after the buyback cost. If the stock falls, you roll down the call, you lower your cost basis a little bit, but now if the stock recovers, you run the risk of getting assigned at a loss. You have maybe 2 to 3 ways to manage the position. I buy a call and the stock moves up. Hey, I can roll that call up. I can close half of the long calls, maybe sell a call against it to create that calendar spread, which no one said that they were doing. That's assuming, of course, the long call or the long put I bought was further out in time. So maybe 2 to 3 ways to manage those effectively. What about the credit spreads? Well, when the stock falls, if I'm in a bull put spread, I can close it if I've hit my trigger, because I can't allow more than a 50% loss, because then that skews that simulation we just saw even worse against us. So I've got to keep those stops at around 50%. Or maybe I just rolled down the whole bull put. Well, in order to get the money back I lost, if I got 25 cents on a 2.5 point spread, that'd be our 11-12% target return, and the stock falls, I'm at a 50% loss. If I just move the spread down, what do I have to do now? Well, I have to go 6 to 8 months out in time to try to get the credit back, or I have to increase the strike prices to make up for it in that one trade. Now I'm sitting on something for 6 months, holding a leverage margin for 6 months, hoping it stays above those new strikes and I can get back to break even. 6 months away. That's really going to damage my annual percentage return to just try to manage this one position that got away from me. Same with credit spreads and calendar spreads, debit spreads. Those leverage returns, once you take that 30% loss from an unexpected event, you've got to go much further out in time or increase the strikes, which increases the risk if the stock continues to move against you. On those leverage strategies, buying calls, buying puts, maybe some straddles, bull put, bear call, credit spreads, iron condors, even diagonal spreads, how constantly are you watching the market, following trends of if the EMA turns, the MACD turns, the Bollinger Band shifts, distribution, or anything along those lines? How much of your time and attention does it take to keep you in that needed 60% win ratio for the long calls to see the success you were promised, or 80 to 85% in credit spreads and debit spreads to hit the targets that you were promised, assuming that at some point you probably are going to see a 30, 40, 50% drawdown. Whereas the proper structure alone can put us in a situation where we can be wrong more often than right and still make money over term. But we're not planning just holding that married put position and doing nothing. How about 12 different ways to adjust that initial structure in different market conditions? The stock moves up, stock stagnates, or the stock moves down. That's what you have in the blueprint. 12 different ways to manipulate this initial structure to, yes, generate income as you're possibly doing now. There's 3 or 4 what we call riskless spread trades that can be done in this context. What do we mean by riskless? It means that I can do ratio spreads in the structure, which don't take on the infinite risk of a standard ratio spread, don't require any margin because of the proper structure. I can do other credit spreads in this structure where I don't have to put up the margin from the difference in strike prices because it's already covered, but I still get the credit. I still get the advantage of the extra return on a ratio spread in this proper structure without having to put up higher margin to take the higher risk. And that put option itself, there's actually 4 ways, 4 of the income methods technically, that I can use to manipulate this position to lower the cost basis, lower the initial at risk, and even profit both directions. So it's not just about the initial structure. It is a trading plan with 12 different ways, 12 different adjustments you can use in different market conditions, better management than what we have on the standard positions and those common option strategies, which aren't really answering the promises that we saw when we first started trading them, and only offer 1 or 2 really good ways to manage those trades as well. And the blueprint is what? Well, it's the full manual on how to use this technique properly in your portfolio. The components of that proper structure we just saw to control risk better than a stop order and leave the upside open, which we don't see with the standard option strategies of covered calls, naked puts, and even credit spreads, which have a capped gain. How to use and when to use those 12 different income methods to take that initial risk of 4, 5, 6% and potentially cancel all of the risk and end up with a trade where even if the stock falls, you have a guaranteed profit to the downside and unlimited profit potential remaining to the upside. Different ways to use the income properly, including nested riskless spread trades and other standard option strategies inside this proper structure. A special chapter on combining income methods. I might use 2 income methods at once to get myself closer to bulletproof. We showed an example of that earlier this month, and earlier, I should say later in December, but earlier in this month as well, on how we could have managed a position we had opened for 10 days to bulletproof the trade in 2 quick moves and have no risk going into earnings. Of course, there's several appendices, examples, And each income method chapter comes with what's called a discussion of the SIGA model to help you decide when to do the income methods and how to do them properly. That's what's in the blueprint, and now is the last time to take advantage of those special bonus offers for extended end of year bonus. Go to radioactivetrading.com/EOI. This ends at midnight tonight. Ernie decided to extend it through today, through January 7th at midnight. We're offering 8 special bonus offers if you pick up the blueprint before midnight tonight. Just go to radioactivetrading.com/EOY. You'll get advantage of the 8 bonuses, including one of the Mastery Series videos for free, The Foundations of Radioactive Trading. You'll get 2 months at a discounted price, only $10 per month for the Fusion access at radioactivetrading.com, where you can follow mine and Ernie's trades and other radioactive trades that are posted and see how we use these income methods and the proper structure in a real-world example, in a real-world trade. You can get a month of power options for free as well, but you don't have to use any of those 2 right away. You can take your time, go through the blueprint, learn some of the content, take advantage of some of the extras and blueprint members-only webinars that are available, and then access that first discounted 2 months of Fusion or the free month of power options when you're ready. The blueprint is an electronic copy now, so you get immediate access once you make the purchase. You always have free email support, and of course, it always comes with a money-back guarantee. If you pick up the blueprint to lock in these 8 bonuses, and you decide after the first 10, 15 days that you don't think the structure is right for you, that you're not sure if it's going to be right for your portfolio, just let us know. We'll refund your purchase price, no questions asked. But we're not extending this again. This ends at midnight tonight, so to get these special 8 bonuses that we offered at the end of your promotion, you want to make sure that if you're interested, and if you want to start controlling risk right now and have the advantage of 12 different ways to adjust a position, pick up the blueprint tonight before midnight. The next steps, I'll get this recording up for you in the next hour or so. But if you do have any questions, send me an email to support@radioactivetrading.com. Or you can call us at 302-992-7971 during market hours. But really, most of your questions are going to be answered in the blueprint. Head on over to radioactivetrading.com/EOY. Pick up your copy of the blueprint. Lock in those special 8 bonuses before the offer ends at midnight tonight. Start trading the proper structure. With just the proper structure alone, we saw with the trade simulator tool can outperform the common option strategies that you're using. You control risk better, still have the advantage of hitting the target returns you're probably expecting without seeing 40, 50, or 60% drawdowns in your portfolio. The blueprint will answer most of your questions. But again, if you do have a question, send me an email today. Give us a call during market hours. I'll let you know when the replay is available. You can rewatch this and have time to do it. But the offer ends at midnight, so you want to make sure that you get your copy before midnight tonight. All right, ladies and gentlemen, thank you for joining me today. I hope you do take advantage of this offer and start controlling risk in your portfolio. But of course, I'll still be around to help you out along the way. You'll still see other presentations from us going forward. Take care, everyone. Good night.